Hello ladies and gentlemen, my name is Garrett Merlo. Today I will be talking about Peachtree Securities Incorporated, Case A. For our first slide here, we see the expected rates of returns. The first being the T-bond at 8%. It's important to note that the T-bond is considered risk-free, and that's due to the fact that it's independent of the economy, because the Treasury must pay the bond regardless of what happens to the economy. The next is TECO, and TECO's expected rate of return is 3.5%. Gold Hill's expected rate of return is 8.8%, and the S&P 500 fund rate of return is expected to be 15%. The next portion here, we look at the standard deviations and coefficient of variance for each. For the T-bond, it is very close to zero. For TECO, the standard deviation is 11.7%, the coefficient of variance of 0.86. For Gold Hill, has a standard deviation of 9.01% and a coefficient of variance of 1.03. For the S&P 500 fund, we see a standard deviation of 16.43% with a covariance of 1.095. And it's important to know that the coefficient of variation is a much better indicator of risk than the standard deviation. We see the lowest risk here being TECO. Looking at this table here, we see a portfolio that has $10,000 in Gold Hill and $10,000 in TECO. When these two are combined to make portfolio A, we see a return of 11.15%. Standard deviation of 8.4%, and a coefficient of variation of 0.75. Later we will see the risk-lowering factors in diversification. Now we see that same portfolio, but instead of it being weighted 50-50, it is now weighted 75% to Gold Hill. That being said, that lowered the return of the portfolio to 9.975%, with a standard deviation of 8.7%, and a coefficient of variation of 0.87. Now when we have that same portfolio, but instead of it being 75% weighted to Gold Hill, it's now 75% weighted to TECO. This increases the return on the portfolio to 12.325%. Lowers the standard deviation and the covariation, making it a less risky portfolio than the previous. Now we look at a second portfolio, which has equal weights of TECO and the S&P fund. This has a much more significant return on the portfolio and a much lower standard deviation and coefficient of variation. We see the return of the portfolio being 14.25% here. This here shows the slope of each three of the T-bond being in blue, TECO being in gold, Gold Hill being in red. This here determines the beta of each of these investments. The beta of TECO being 0.7, as we see in the slope intersect. The beta of Gold Hill is negative 0.3867. And of course, there's beta of 0 for the T-bonds because there is no risk at all. The required return is above the line there. As I was saying about required rate of return, here we determine the required rate of return by using the CAPM formula. This here is the CAPM formula. It is the risk-free rate plus the product of the market rate minus risk-free rate multiplied by the beta. So, using a risk-free rate of 8% and a market return rate of 15%, and using TECO's 0.6 beta, we see that the required rate of return for TECO here in this situation is 12.2. Now in the next coming slides we will see different scenarios and how this will change. If the inflation increases by 3%, that would mean that the the risk-free rate will increase to 11%. We see a change here, the required rate of return of 13.4, an increase. If the market risk premium rises to 8%, we see a slight rise in the required rate of return to 12.8%. Now, if all those conditions were back to normal, but the beta rose to 1, we would see that there would be a large rise in the required rate of return to 15%. So another great question is, how will the long-term debt ratio impact riskiness? Well, if the long-term debt ratio of TECA were to decrease, the riskiness of the company will decrease as well. When the riskiness decreases, so does the required rate of return. Thank you, everybody. I hope you have a great day.